In this video, I'm going to talk about the difference between a stop market order and a stop limit order. Stay tuned. Hey traders, a very warm welcome to you. Okay, so this is quite an important video to make because this is the difference between kind of losing more than you expect and keeping things under control. There are two types of stop loss order, and this is going to be dependent on the broker you're using. Sometimes they label these differently, but what I really want to do this video is not talk through how each broker does it, but just to plant the seed that says if you're not aware of this, and if you are, great, you flick off to the next video. That makes a lot of sense. If you're not, then this might give you a little bit of an insight into how the stops work. So we've got, we all, by this time, I'm assuming you're familiar with the stop order. If you're not, go and check out some other videos I've done on stop orders, basically limiting your loss. And I'm looking at these from a perspective of, hey, we're in a trade and we want to limit our loss as opposed to getting into a fresh trade, although it equally applies. So we've got two types of stop order. We've got a stop market order, I'm going to put MKT, and we have a stop limit order. Now, as I say, not all brokers offer these, or they might call them something slightly differently. But like I say, it's just for you to kind of look and see and show you the difference between the two. So what does a stop loss order do, first of all, and how does a stop loss order execute? So stop market order, let's talk about that one first. I'm going to use this example here with Amazon because it's a great example. Let's say that we have gone long Amazon at 10.50, okay? Gone long Amazon at 10.50, and we think that the market is going to push up higher over the next few days. So we go long, let's say we go long £3 a point, or 3 CFDs, or 300 shares, whatever it may be. The point is we're long at that 10.50, and we say, okay, you know what, I don't really want to risk more than let's say $15. Okay, so our stop's going to be at 10.35, and my line's not exactly right, but you get the idea. So $15 risk on the trade multiplied by a position size. That's what we want to do. So we put in let's talk about the stop market first. Now the stop market order, what does it say? And remember, the price that we're putting in as 10.35. Let's note that down as well. In fact, I'm going to put it over here so it's out of the way. 10.35. All right, guess we can all see that. Let's put my little dollar sign here. Good enough, you get the idea. 10.35. I'll do my little 3. That's our stop loss order. So what actually happens? What is actually saying? We're basically saying, hey, listen, when the price gets to that, I want to get out. Now, if we use a stop market order, let's see what happens in this scenario. So in this scenario, the price opens up at, let's call it 10.10. Okay, it opens up 10.10, which is way lower than our stop loss order. Our stop loss order, remember, was set at 10.35. The next time the price opens, because it closes, the bell goes, ding, off we go, everyone goes to sleep, wakes up the next day. You can't trade Amazon again until the next day. It opens up at 10.10. What happens? With a stop market order, you are going to be filled at 10.10, because what the stop market order is saying is it's basically saying, hey, listen, when the price hits 10.35 or lower, I want you to fire this order into the market. And a market order just says fill the order with no regard for price. So it's going to sell your £3 a point, 300 shares, whatever it is we talked about at the market, and the market price happens to be whatever the open is, 10.10. So you're going to get filled on that stop at 10.10. That's going to be what's called slippage, because you didn't want to come out of that. You wanted to come out at 10.35, but that's the first available price that was trading under your stop. So obviously the advantage of that is that you come out regardless. You're out of the position. No matter what price it is, you're out of there. The disadvantage is you could be getting hit at an awful price, a dreadful price. And you've got no control over that. That's the point. That's why when you put that order in and you give it that market condition, you are giving up the facility to have an impact on the price, or to have a say in the price, because by definition a market order says get me in or get me out at whatever price possible. Okay, now the other option we've got is to use a stop limit. Now if we use the stop limit, There are different permutations of it, but let's keep it simple for now. We put our stop in at 10.35, our sell stop, and we say, hey, when it's a stop limit, that instruction is basically this. Listen, if the price gets to 10.35, yeah, I want you to sell me my 300 shares or my £3 a point, whatever it is, at 10.35, but no lower. Okay, I don't need to go any lower. So that's a limit order. So you've got full control over price. However, in our example here, where we opened up at wherever we were, 10.10, right? It's not going to fill. You are still going to be net long on the position because the stop limit hasn't filled. All it's done is it said, yep, okay, the stop limit is triggered, it's now live, but my instructions are to not sell my position at anything less than 10.35 because that's the definition of a limit order. So you are going to be in that position, it's going to be active, and as soon as it comes back up and hits 10.35, if it does, you're going to be out. But if the market carries on lower and lower, which in this case it just didn't quite take, then you're gonna still be in the position because your stop limit says, hey, don't sell anything lower than 10.35. Now obviously the advantage of that is you have control over price. It means that you're not getting slippage on some rogue kind of spike that may come back. But the disadvantage is that you're not guaranteeing to come out of the position. You know, if it gaps below, like in that Amazon example, you're stuck in that trade and you've got to make a decision what to do. Now, let's just look at another really brief example, guys. If we made the stop 10.30, for argument's sake, with this, let me zoom in on this for us. Okay, 10.30, and we opened up at 10.10, for example. With our stop market, we're going to get filled straight away at 10.10. We're going to lose that. However, if we had a stop limit, it's going to go in. But intraday, in this case, it pops back up to 10.30, and then we get stopped out at 10.30, giving us a $20 extra on that trade. It's obviously not always going to work like that. If it carries on falling through the floor, you're stuck. But that's the kind of decision you've got to make. Now, most of the time, when there's no inherent gap risk, if you're trading kind of Monday to Friday on currencies or indices, you're going to be okay most of the time. Apart from obviously some real black swan events. But it's worth bearing in mind. It's worth checking with your broker if they offer that. It's worth checking out, you know, whether you want to use that as part of a strategy, and worth understanding what you're really saying when you put in a stock market order, especially when you're trading something that's inherently got some gap risk in it. Okay, guys, hope you enjoyed the video. Thumbs up if you did. Don't forget to subscribe if you haven't already, and I'll see you in the next one. Good trading. Take care. Bye-bye.